In the quiet, unassuming world of central banking, a seismic financial event just took place, one that didn't involve complex derivatives or risky tech stocks. Instead, it was powered by the oldest and most trusted asset in human history, Switzerland, a nation renowned for its precision, neutrality, and financial prudence, just revealed a staggering profit in its third quarter. A figure so large it defies easy comprehension: 27.93 billion Swiss francs, or roughly 35 billion US dollars. This wasn't a windfall from a lucky investment in the latest market fad. The source of this immense wealth was something far more ancient and enduring: gold. The Swiss National Bank, or SNB, saw the value of its vast gold reserves skyrocket by an incredible 14.33 billion francs, equivalent to nearly $18 billion. To put that into perspective, this single quarter surge in the value of its gold holdings was the largest since the year 2000, the very year the SNB began marking its gold to market prices. It was a clear and powerful signal that in a world teetering on economic uncertainty, the old saying holds true: as good as gold. The fascinating part of this story isn't that the Swiss bought more gold. They didn't. Their physical reserves remained stable at a formidable 1,040 tons. What changed was the world around that gold. As geopolitical tensions flared across the globe and whispers of an impending Federal Reserve rate cut grew louder, investors and nations alike scrambled for safety, pushing the price of gold up by more than 57% year-to-date, according to experts at UBS, one of Switzerland's banking giants. The SNB's monumental profits are not a stroke of luck, but a natural consequence of a deliberate, long-term strategy. For decades, the Swiss have understood that holding safe haven assets like gold is not just an option, but a necessity, is the ultimate tool for diversifying a nation's reserves, financial bulwark against the storms of economic and political instability. The SNB's quiet, disciplined approach to holding gold has now paid off in a very loud, very public way, turning their national balance sheet into a fortress of financial strength. And Switzerland is not alone in reaping the rewards of this ancient wisdom. Just over the Alps, Italy stands as another testament to the enduring power of gold, while often discussed for its public debt. Italy holds a secret weapon: the world's third-largest national gold reserve, trailing only the United States and Germany. With 2,452 tons of the yellow metal tucked away in its vaults, Italy's holdings are worth approximately $300 billion. This colossal sum represents a staggering 13% of the nation's entire GDP, a silent yet immense source of stability undergirding its economy. It's a powerful reminder that true wealth isn't always what's most visible. Sometimes it's what lies hidden, secure, and unyielding. This global shift back towards the security of gold is a phenomenon that legendary investor Ray Dalio, founder of the world's largest hedge fund, Bridgewater Associates, has been discussing for years. With the clarity of a seasoned historian, Dalio has often declared a simple, profound truth: gold is the real money, with the least risk of devaluation or confiscation. In his view, the paper currencies we use every day, known as fiat money, are locked in a cyclical dance with gold. Dalio's analysis of monetary history reveals a recurring pattern. Whenever public confidence in fiat money begins to wane, gold inevitably shines. He points to crisis after crisis as proof. When a government faces insurmountable economic pressure, its most common response is to turn on the printing presses, creating more money out of thin air to cover its obligations. This act, while a temporary fix, ultimately devalues the currency, eroding the purchasing power of every citizen. And every time this has happened, the price of gold has reacted by surging dramatically. It happened in the inflationary spiral of the 1970s. It happened during the global financial meltdown of 2008. It happened again in the unprecedented money printing era that followed the COVID-19 pandemic. In each instance, as the value of paper money was called into question, gold reasserted its role as the ultimate store of value, a financial anchor in a sea of uncertainty. Based on this historical cycle, Dalio's advice to investors is both simple and powerful. He recommends allocating between 5% and 15% of any investment portfolio to gold. This isn't a strategy for chasing quick profits. It's a defensive maneuver. Holding gold, he argues, helps to dramatically reduce a portfolio's overall volatility. It acts as a form of financial insurance, preserving your purchasing power and protecting your wealth during the inevitable crises that punctuate economic history. It is the asset you own not for the money it might make, but for the money it will save when other assets are collapsing. As we look at the world today, the reasons for Dalio's conviction become clearer than ever. The United States, the bedrock of the global financial system, is now grappling with a national debt that has swelled beyond an almost unimaginable $35 trillion. This mountain of debt creates a precarious situation, forcing the government into a corner where printing more money seems like one of the few available escape routes. Simultaneously, geopolitical tensions continue to escalate around the world, creating a pervasive sense of instability and risk. In this environment, Dalio predicts that gold will continue to be a primary beneficiary. It's an indispensable insurance asset. It's a unique hedge that performs well in two diametrically opposed scenarios. If the global economy tips into a severe recession, investors will flock to gold as a safe haven. Conversely, if governments continue to print money to stimulate growth and manage debt, leading to runaway inflation, gold will also thrive as it protects against the devaluation of currency. In a world of increasing uncertainty, the silent, gleaming bars of gold held in vaults in Bern, Rome, and around the globe represent more than just wealth. They represent certainty, stability, and the timeless pursuit of financial security.